Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the gold, silver, and copper markets for Tuesday, March 15th. Starting off here with an intraday 4-hourly chart of the April gold contract, you can see overnight's clear impulsive break below last week's 1403 low that confirms at least the intermediate term trend is down, exposing a larger degree correction or a reversal lower. By virtue of this week's relapse, the market has defined the 1433.5 high from Monday as the latest and tightest corrective low this market's now required to recover above to expose this sell-off attempt as a three-wave and thus bull market corrective sequence. While the market remains below that 1433 level and in lieu of a developing bullish divergence in momentum needed to threaten this slide, further and possibly accelerated losses remain anticipated on the heels of, looking here at a daily log scale chart, the very good prospect that the 1445 spot 70 high from March 7th completed a 5-wave Elliott wave sequence up from that January 28th low at 1309. Indeed, this could the past week and a half's weakness could just be a 3-wave correction of this portion of the secular bull trend, in which the 50% retrace of that 1309 to 1445 rally cuts across at 1376. But we can come up with all kind of derived levels to subjectively believe the market might hold at those levels, but the crux of the matter is the trend clearly is down, and the only objective technical factor or tool used to confirm some kind of base and recovery from such a clear and present downtrend is a confirmed bullish divergence in momentum, and we clearly do not have that at this stage. And you can also see that by virtue of the weakness below 1410 over the past week and a half, the market has confirmed a bearish divergence in daily momentum, adding or contributing to the broader peak and reversal threat. Looking here at the weekly log scale chart is the historically high levels of bullish sentiment, and both the bullish consensus and our MRT bullish sentiment index, that combined with this clear momentum failure and confirmation of at least the intermediate term trend is down, leaves this market vulnerable to further and possibly accelerated gains. With such historically bullish sentiment, and now that the fact that the market has in fact reversed, we don't want to underestimate the extent to which this market might now be vulnerable to lower levels, including a return to the lower recesses of the past few months' range down around that 1309 area. These issues considered, a bearish policy remains advised with strength above at least 1433.5 required to defer or threaten that count. Moving to the silver market, you can see yesterday's and overnight's relapse below Friday's 3405 low that confirms at least the intermediate term trend is down. And perhaps the most important byproduct of this weakness is the definition of yesterday's 3650.5 high the market is now required to recover above to render this sell-off attempt a relatively minor bull market correction needed to give way to the secular bull trend. From a longer term perspective, looking at the daily log scale chart here, you can see the dominance of the broader bull trend. And while this market has confirmed a smaller degree momentum failure, from a much longer term scale sufficient to threaten the longer term bull trend, we still require a break below the 3169.5 low, corrective low from February 25th, to expose this or to suggest that this latest phase of the secular bull trend from January 28th's 2630 low to the 3674.5 high on March 7th is a complete 5-wave Elliott wave sequence. In this regard, the matter of technical and trading scale is perhaps the most important factor heading forward, for certainly from a short-term perspective for shorter-term traders with tighter risk profiles. The market has weakened enough to warrant moving to a neutral sideline position. But longer-term players remain advised to maintain a bullish policy until the market breaks the 3169 level. Interestingly, from a long-term weekly log scale perspective, the historically extreme bullish sentiment levels are typical of much larger peak and reversal environments, and we must watch closely for that. It's also quite possible that the 3674.5 high from March 7th completed a long-term 5-wave Elliott wave sequence that dates all the way back to the February 10 low at 1483. So it's well within the realm of possibility that this relatively minor weakness thus far are the baby steps of a reversal of a peak and reversal environment that could be absolutely major in scope, with the break over that 3169 level, the threshold perhaps that would reinforce that major reversal lower. In sum, shorter-term traders with tighter risk profiles have been advised to move to a neutral sideline position as a result of of this weakness, but longer-term traders remain advised to maintain a bullish policy with a break below 31.69 required to take defensive measures for those longer-term traders. And finally, looking at the copper market, the overnight's break below last week's 408.60 low perpetuates the broader slide, and perhaps most importantly defines Friday's 424.5 high, this area of former support that we expected to provide new resistance after being broken mid last week. In fact, played its role very well, and that 424.5 corrective high, as a result of today's new lows, is confirmed as the latest and tightest corrective high this market is now minimally required to recover above to arrest this sell-off, perhaps expose it as the end of a three-wave and thus bull market corrective sequence ahead of potentially a resumption of the secular bull trend. While the market remains below at least that 424 level, and preferably, moving here to a daily log scale chart, preferably the 455.40 high from March 4th, you can see the nice development of a peak and reversal threat that could be absolutely major in scale. For moving to a weekly log scale chart here, you can see the prospect that the 464.95 on this weekly active continuation chart basis arguably is the completed fifth wave of a major five-wave Elliott wave sequence dating back to the June 10 low at 272, along with a confirmed bearish divergence in weekly momentum and historically high bullish sentiment. Again, as we've discussed for the past week or so, all the factors are present for a peak and reversal threat that could be absolutely major in scale. These issues considered, a bearish policy remains advised with strength above at least 424.5 and preferably 455.40 required to defer or threaten this new bearish count. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.